live at 5, everybody, or 4 Central, which is where I am. Welcome, everybody, to our happiest hour of the week, the Get Think Tank Hour. Cynthia Murphy, head of research for the ETF Think Tank, and we have a great show today. We're very excited to be here. We'll do our quick round of introductions. Weiskopf, why don't you go next?
The ETF professor, also lead ETF strategist for the ETF Think Tank, where we help financial advisors build better portfolios. That's me. I'm also co-portfolio manager of Block. David, you're up.
How's it going, everyone? David Chikansky, fellow portfolio manager, focused on the SoFi Gig Economy BYOB ETF, as well as the Amplify Inflation Fighting ETF. Today should be a lot of fun. Yield, yield, yield. We're going to be talking about yield all day long, so I'll kick it off to Gavin.
Thanks, David. Gavin Fillmore, COO of Title Financial Group. I like to refer to myself as a recovering bank guy. I spent most of my life on traditional Wall Street, and I'm very happy to not be there anymore. Had the pleasure of being part of some of these unique products that were created with the help of my wonderful partner, Jay. So I'll hand it off to Jay to intro himself.
Thanks, Gavin. Jay Pestrichelli, CEO of Zega Financial, product manager of the portfolio manager of the YieldMax ETFs, all around options guy, mad scientist that Gavin kind of got me going on these things. So excited to be here to talk about it. All right, Mike, over to you, I guess.
Yeah, the order went a little different than usually. Usually I get to introduce our guests, but that's all right. I like it.
Gavin joins us, and all of a sudden he
Gavin
gets
bulldozed it.
It's all good. I love it. I love it. I love it. So this one's very special for us because this is a strategy that we built with a client, right? Jay is now a client and a partner, and we're going to be talking a lot about it. We did a great Twitter Spaces on the YieldMax concept last week, and Jay and Gavin and some of our other partners are ringing the bell tomorrow. I'm kind of 50-50. I might have got sick during this week of being in New York City. As always, we like to have a drinking word because this is a happy hour. This was our response to being locked up, and now it's like we just stay in the house anyway.
Now we're just addicts. Yeah.
Since we're talking about YieldMax, we're going with yield, so hopefully you're drinking something that's not 100 proof. What else? I put some links in the chat to Zega Financial, to YieldMax ETFs, all that. We're gonna try and be very compliant, so we're going to be talking more about the strategy than the actual ETFs themselves. So try and, if you have questions, focus more on the strategy for us. I'm going to promote some of you up. If you have Q&A, use the Q&A button, use the hands and the mutes and all that fun stuff, so we get an orderly conversation going. So I guess I'll kick off the first question to Jay, which, before we get into the strategies, let's talk about you. How the hell are you qualified to build these complicated option strategies using all kinds of income and my understanding, this strategy isn't even long anything. You're synthetically long and then creating income. So what qualifies Jay?
Yeah, fun. All right, Mike, fun with options, right? That's what we could call it. So Zega Financial was founded in 2010. We are predominantly focused on running strategies that are options based. Of the 16 GIPS compliant strategies that we run, they're all options based. Before that, I ran the active trading business at TD Ameritrade for a decade, right? So whether it had to do with the trading platforms, the marketing, the communication, the service, all that ran through my department. So yeah, just all around, always loved the trading space and the option space. I'm an engineer I went to college for that, never worked a day as an engineer, but I get the benefit of saying, in this current role and running Zega and running the portfolios, I get to use calculus every day. And so, when you said, when am I ever going to use this in high school? Yeah, I get to use that every day. So yeah, just options in general are what, our firm is really passionate about. Our team combined has over 120 years of option trading experience. And we like to look at unique ways of kind of creating more efficient models in the marketplace.
All right, so then we'll go to Gavin next, and then from here we'll start raising hands and figuring out where we're going. What is the nexus of these strategies, Gavin. Like let's cover what is a single security ETF, as well as how did we get to the development of these strategies.
Yeah, so I think this is one of those really amazing examples of kind of group think and people coming together that already work together in different forms and started throwing around ideas, and all of a sudden you look at each other and you're like, wow, we've got something that's like powerful here. And the genesis did sort of begin with a change in the marketplace, where all of a sudden single stock ETFs were possible. And that was shocking, I think, for almost everybody, because it wasn't a rule change. It wasn't like the SEC came out one day and said, oh my God, we're okay with this now. So for, decades, right, Mike, I think we all heard you can never do a single stock ETF. You couldn't even do 5 names. You can do 10 names. There's diversification rules. And then somebody had a good idea, and it wasn't originally us, right? And let's be frank. Somebody else filed for the first leveraged single stock ETF, and everybody said, wait, what changed? And the reality is nothing changed. It's an example of regulatory arbitrage. And then it worked, right? It got through the SEC, and everybody said, oh, okay, now the game changed. Now, what happens in a lot of cases is people crowd around the same idea. And that's what happened, right? Everybody started chasing leveraged single stock. And we saw that and said, okay, crowded ideas aren't easy to succeed up against big name providers. But what else could be done? At the same time, we were exploring what we might be able to do to create sort of synthetic yield on Berkshire. And once we said, oh, maybe we could do that, I said, wait, why don't we do it on some higher vol names? Because at the end of the day, and I'll let Jay talk more about this at depth, but this has less to do with the name itself. It has more to do with the volatility of the name. And running a strategy like these on high vol names means that you can generate extremely high yields, and that is what gets really exciting. So I'll pause there, but I would just highlight groupthink. Kind of looking at what's going on in the ETF market and bringing it all together, and then you have an aha moment.
All right, so why don't we just say what the strategy is then, so we can get that out, right? So we did file for a number of these, but the first 2 that we launched is a strategy in the ETF format that is essentially long Tesla and sells calls against it to generate income, and another one that is long ARK. We have to say innovation to be nice to Kathy, and sells calls against that. And we just did a press release that the annualized yield of those calls, because these are both very volatile things, is around 65%. I'm sure Warren, I can see his face, he's getting excited. And he loves some buy rights. Astronaut ice cream and buy rights. That's his world. That's the strategies, and the idea is to roll out this concept on a number of things. When we did the Twitter Spaces, we had a Tesla bull on, which seems to be less passionate than the Tesla bears. We also had a Tesla bear. Man, he scared me. But the beauty is these strategies are not really about being bullish or bearish. It's about expecting volatility, because that's where you get the more income. So Jay, when you're managing this, you know what the income is going to be, because you're rolling these weekly options. How is that determined, this 65% annualized option yield off of this? Like what causes that? How do you decide it? Like, yeah. What does a day in the life of Jay, the options guru, trading this stuff look like?
Well,
Yeah,
like
explain the magic.
Yeah.
Sure. Okay. So as you said, it definitely depends on the volatility of the underlying ticker, right? Some of the ones you mentioned, like the way Gavin said, we started talking about Berk, that's got a fairly low volatility. You should not expect that to be in the 65% range, right? If we, launch that fund. But when you look at a ticker like Tesla, and it's got an implied volatility that ranges from 65 to 100 over the last few months, then that is really the thing that helps define the cost of the options, right? Really, it's actually the other way, right? Options are expensive on Tesla, and so that pushes up the IV, and that gives us an idea of, generally what we should expect out of a stock with that kind of volatility. And so, when you get those, I mean, look, the fact of the matter is when you could sell calls that are 5 to 15% out of the money with, 3 or 4 trading days to go for 1%, that's the thing that ends up adding up and compounding to the 65% number. And so while we shoot for 65, if the volatility on Tesla went to 120, then guess what? That number would go higher. If the volatility came down, you wouldn't be getting as much for the calls that you're selling. And so it's really the option premium that is driven by, how much the underlying stock moves. And so it's all interlinked, but the covered call strategy, which is essentially what we're doing here, right? You mentioned that we don't even actually hold long stock. We synthetically are long the stock. But a covered call strategy is generally bullish. You do a little better when, it goes up, but we're really just trying to harvest the premium out of those calls. And when you could sell those for 1% a week, 1.5% a week, that's what we're going to distribute in the dividend. And that drives that yield.
We finally said yield. We finally said it.
If I may jump in, I think Jay is now officially the options magician, which means we get him a cap and cape for the next time he's on. What do you think, Venuto?
I'm down with that. Jacansky, I think you're up next.
Yeah, what would in theory like a GameStop or Bed Bath & Beyond yield? Like how much yield would you get in one of those types of stocks?
Yeah, the yield on those, well, like their vol is like a 200% vol. I mean, at that point, we probably want to sell farther out of the money, right? But still, it's commensurate, it's linear, right? 200 vol, we should probably land 180% if you wanted to do something like that. So there is one little, weirdness with this, right? Like vol is not always straight down, right? Your calls don't always depreciate to zero. Sometimes those calls go in the money, right? And so you'll cap your upside, right? So sometimes while you're happy to get that yield, you may not get all the upside of what a GameStop or AMC may do. So you have to be willing to give up a little bit of that. But if it's all about the dividend, which for us it is on these tactics, on these strategies, then you should be okay with that because the underlying value of your ETF is what's going to generate the yield, right? It's nice when it goes up, but it doesn't have to. If it goes up too much, we also get capped there. But yeah, it's all, they're linked. It's linear. Go ahead, Mike.
Actually, I'll let Professor go, and then I'm going to bring Eric Connolly up because his question is relevant to where we're going. So
this week's yield, whatever you want to talk about, may not be next week's yield. Is that fair to say, right?
Sure. Yeah, absolutely.
So while we might be talking about 120% annualized yield, sometimes it might be 60, sometimes it might be more or less. So I just, I say that because sometimes, like they say, there's no free lunch, right? So don't want to get anybody too crazy excited about it. And also there is the possibility, by the way, that, well, the price may go down. So
yeah. Oh yeah, take the first 3 weeks that we launched. Tesla goes from 180 to 100, right? And even though we were selling calls all the way down, we didn't make up for an 80 point drop in the underlying stock. So that is the risk of a covered call strategy. This isn't hedged, right? Yes, we were selling calls all the way down and earning premium, but we felt the full force of the decline of the stock. So you're right. The ETF can absolutely decline in those situations. And then the risk is it goes up from 100 to 200 in a period of 3 weeks. Oh, hey, that's what happened also. And so now you end up capping and not getting the whole upside. And so, as luck would have it, you always get the most challenging environment the first month you launch a fund. This has probably happened to me now 3 times. And so, but that's okay, right? We're still producing the yield. We're still doing what we're trying to do and, sticking with what the strategy wants to do. But yeah, it's not always straight up. The counterpoint that I would make to that is, take advantage of that and reinvest the dividends. And that's probably a whole different conversation about how fast you can grow.
So that gets to the question that I was kind of going for, right? If you're at point A and you're headed to point B in 6 months, and there seems to be a more reasonable probability in certain stocks, maybe Tesla, that it is by the nature of the character of the stock, it's going to be volatile. That actually may be the best strategy than being extremely bearish or extremely bullish, because you can see how you can get there. I don't know how anybody, goes so extreme on these names.
Yeah, I mean the bulls and the bears on these things are so extreme.
Yeah.
But
Yeah,
when we did the Twitter Spaces, I tried to get both the bull and the bear to answer, would they own a strategy that does this?
Yeah, you did.
Yeah, and the bear, he was just like, I don't even want to talk about it. Let me tell you why Elon's a scam. The bull, he was like, hell yeah, if it goes sideways, this is the best way to play it.
Yeah, it's
Yeah.
almost, think about this, when you invest with one of these types of products, you're actually not directional, right? You are betting on, high vol or low vol, really, right? It's weird to invest in volatility, right? We always hear volatility investing is the VIX. And by the way, that's really hard to do because you got to do calls on the futures. It's a nightmare if you've ever tried to trade the VIX itself. But the concept of trading volatility is not how everybody learns to invest. We learned buy low, sell high. That's the way you make money. You could do it in a reverse order, but that's what we learned. Well, volatility works the same way when you execute, but for us, time is the one thing that I could count on. Like there's only one thing I can guarantee that happens in Wall Street. I know that tomorrow comes after today. And that's what selling volatility like this benefits from, because you get that time decay in the options. And the more volatile that today was and tomorrow may be, the more you're going to get for those options. It's a different way to think about it, which is why I like to classify this as more of an alternative investment versus a directional investment.
All right, so we've got 2 questions in the audience. I usually wait a little longer to go, but they're both structure matters like questions, Weisskopf. So we're going to start with Eric. I think Gavin's going to be more appropriate for answering this because it's about the regulatory arbitrage. And then Jonathan's back. I don't think he's been here for a while, so I'm glad to see him back. And he's got a good structure question too. So fire away, Eric.
Why construct the long synthetically, and is the income qualified?
Yeah,
You stuck that one in there.
Yeah, but yeah, we'll definitely hit on the synthetic. So I'll answer part of it, and then I'm going to let Jay answer maybe the other part of it. So it does relate to the regulatory arbitrage, but then there's other good reasons too. So I'm going to let Jay tell you the other good reasons. On the regulatory arbitrage side, the trick, if you will, was the idea that you can fulfill your diversification requirements with treasuries. So as long as you have enough treasuries to post, you fulfill your diversification rules. So a good way it would be more challenging to run this strategy if you bought the long equity outright and then put the options on top of it to meet that. I should say really impossible. But by doing it synthetically with options, you can indicate, by the way, unrelated to this product, when you look at the leveraged products that are out there, they're sourcing their exposure on swap. They only have to post the collateral to the banks, and therefore they have enough in treasuries to fulfill. But Jay, correct me if I'm wrong, there's actually other good reasons to do the synthetic combo rather than the stocks outright as well, correct?
Yeah, no, that's true. So there's a few reasons why, as you said, Gavin. The main one, though, is the concentration requirement, right? Secondarily, when not only do we use synthetics, we actually will use flex options for the synthetics, European style flex options. So a few reasons why we like that. I'm going to nerd out a little on options here for a second, but European, you can't get assigned early, right? A synthetic is a long call and a short put. When that short put goes in the money, right, you don't want to get assigned while you're trying to manage your, the amount of concentration that you have. The other reason is we can, do basket swaps in an ETF format where we can be a little more tax efficient when you have gains, right? And you could roll those positions out. Now, if you were just long stock, you never have to sell it, right? It's fine. But with the synthetics, it helps from the construction. It helps avoid any accidental leverage. And really for us, it allows us to use those treasuries as collateral as the main holding, and then, create the, synthetic long exposure. I mean, we like this environment also with treasuries where they're paying, right? I mean, there's a little bonus when it comes to that. Now that you pay a little bit for that in the synthetic itself, you can't get, free exposure and earn treasury yield, but still there is actually a little net lift on that as well.
All right, so before we go to Jonathan, let's cover the qualified question, right? This is income, but it's not exactly dividend income, right? So we're not tax accountants and all that sort of stuff, get the disclaimer in there, but my guess is most of this is not going to be qualified income.
Correct.
Yeah. Right. It is options generated income. I don't think it's too much of a surprise. That's why I know you snuck it in there, my friend. All right. So Jonathan, you want to come up and ask your question?
Sure. Hey guys. I've been here. My chat's been disabled for the last few months. I don't know, or a month or so. I don't know. So it's probably been better though, especially if you're drinking a little bit. So I was just curious for Jay and Gavin. What's kind of your capacity expectations on a fund like this? Obviously, Tesla's got a huge market cap, so I'm assuming it's fairly large and liquid. But what would that theoretically be for y'all?
So I'm going to let Jay say capacity with some precision, but I'm also going to throw into this conversation the value of active management, right? So my background, by the way, was much more passive and built just trying to design even option strategies in passive index form. And the reality is it's really, really hard. And one of the constraints is what you're getting at, right? Is how do you source enough liquidity if this scales to $1 billion fund? Well, I'll tell you what helps a lot with that, the ability to do it actively. So you can have multiple strikes, right? You could layer in slightly different expirations and source a lot more liquidity because you have the active management. If you were forced to try to design that into an index and take into account the capacity, you could try to get really, really smart about it. You're still going to come up short versus letting somebody like Jay actively manage a strategy like this. And there's other reasons why active is a better approach here, but actually this is a good example of one, which is the ability to scale this better. Jay, you want to talk about the depth of the options market though, as well?
Yeah, I mean, the Tesla options are extremely active, right? And that's more important to us than the market cap of Tesla itself, right? We always want to have liquidity to trade with. By the way, there are plenty of market participants that want our volume, right? So we actually bid out a lot of our trades, and so that gets pretty. It's interesting, right, to see that market participants want this liquidity. So, I mean, I think all of the YieldMax products that we applied for, we had an absolute minimum that they all could handle at least 100 million in every one of those funds. I think you could easily add a zero at the end of the two that we have live today and still do it in the same strike. So the concentration isn't going to be that much of an issue. If, like, as Gavin mentioned, if you want to spread that out, now you've given yourself probably a 4x of that. So capacity, this would be a good problem to have for all of us here, right? That we've pushed up against the capacity about the Tesla options market, but really there's a long way to go before there's any kind of heartache there.
So we were speaking before the call and talking about like the length of the options you're holding in your strategy, and you mentioned it's in the range of 7 to 10 days. If you could talk about that a little bit more, and just the curiosity in me is asking, like, wow, what would the yield look like if this was all like 0 DT like options? Like, how much yield could you squeeze out of this thing if you were doing 1 day? And what are your thoughts on shorter term expirations and holding that? And
Yeah, sure, David. Right. So the time that the call selling, right, is definitely shorter in nature. We use weekly options for that. 7 to 10 days is a fair time frame to look at. You just end up getting too close to the money with these volatile stocks if you want to do 2, 3, 4 day trades. Maybe a 4-dayer is okay. We had a 4-day week this week, so that we kind of went through that. But the idea of earning more time the more often you could do applies here. I think everybody learned that near the money options, which I'll say we're trading with, have their maximum time decay as they get closer to expiration, right? We all learned this in Option 101. So as doing 4 weekly calls is more profitable from a premium perspective than doing one 4-week call, one monthly call, right? So you'll just earn more doing it weekly than you would doing it monthly. And there's a lot of funds out there that do sell monthly covered calls. One of the largest covered call strategies out there does this, and they do a monthly call. And if the NASDAQ runs up on them, so be it. If it declines, and they'll distribute their 1%. But with these kinds of stocks, it's easier to get to earn your target time premium doing a weekly call, right? 4 weekly calls is much easier. I think you probably heard me reference 1 to 1.5% a week. I mean, that is the first criteria we look at when we're picking a strike to sell, right? Can we make our 1 to 1.5% in a week with options that are farther enough out of the money to kind of also capture some upside? And I think that's an interesting point we could get back to in a minute. The other point, David, that you brought up, you brought up 2 points, right? One was the call selling and doing in the week. The other point, remind me again what it was. The other
Sure,
question.
yeah. I mean, if you shorten the time frame, like how much would you jack up the yield?
With zero DTEs.
Yeah.
So the absolutely right. There have been times where we watched the final last day on a call, and it's the exact amount that we would have made in the week long, right? Because again, if it's right at the money, you're going to get that maximum time decay. So yeah, if there were everyday daily option expirations on Tesla or on ARKK, then yeah, we probably would shrink in our time frame a little bit there too. There is again, we talked about being capped on the upside. We don't love being capped on the upside, right? We don't want the underlying stock to rocket through our short strike price too far. It has happened a few times. We talked about it when Tesla went from 0 to 200, that short time period. It helps you kind of keep the amount of leverage the right amount when and that's kind of an interesting concentration requirement that we have to deal with. But it helps you stay more on task of being, long 1x Tesla while selling covered calls. If Tesla runs up high, you end up finding that you could become a little accidentally leveraged, and we don't want to do that. So there's probably going to be a good balance. If I could think of any single stock that would have dailies, Tesla would probably be in the top 5 that I would think of that would have 1-day options expire.
And I'll ask one last question, then pass it on. What is the premium on earnings week, right? So if it's like 1.5 on a normal week, then like, what is it 80% more? Is it 200% more? What is the income earned expected on earnings week?
Yeah. So if let's do a reference, right? On the last time that Tesla had an earnings, right? The IV went up to like 120 on those near term options. And right. So in those weeks, so we have a choice, right? Do you grab more premium to get a little extra in your monthly dividend? Or do you give yourself more upside capture that in case Tesla really has, like a plus 10% day after earnings, happens all the time. So, do you want to capture more of that and have more appreciation of the underlying ETF? And so there's a unique balance there with the active management to take a look at that. Generally speaking, as I mentioned, we have a yield target. We want to make sure we're hitting that. And we do look more of an average, not the every single day what the implied volatility will be. So if you can still get 15% out of the money and earn our 1.5%, that's a trade we're going to lean towards. If you're still getting, 5% at 15% out of the money, we're not going to go farther out than 15, right? So in those scenarios, we're going to give only a limited amount of the upside, and then we certainly want to capture more of the premium in those scenarios. Does that kind of make sense? So, there is part of the active management here is, looking at a formulaic approach, a disciplined approach to stay within what the prospectus tells us, which is 5 to 15%. We deliberately picked that. And then the other side of it is make sure you're hitting your yield target, right? Those are, the 2 guides that we use amongst, a handful of other things, but those are the main things that we look at when we're kind of deciding what to do.
The duration, the spread between the strikes on the put and the call, right? Like you can get creative on that side, it sounds like.
With the combo, the synthetic, yep.
Yeah.
That is another piece of that too. options expire, right? We could talk a little bit about the combo for a second if you like, but the options expire, right? And our long exposure, our synthetic long, I'll call it. I don't know why I did the air quotes. It's technically is a synthetic long. It's a combo, long call, short, but ignore those. That is something that we're going to have to match once a quarter, right? Those are going to expire. So we're going to trade those. And sometimes those are going to be profitable. Sometimes those will have losses because they're just reflecting the movement of the underlying stock, right? We're going to treat it as if we were a long stock when it comes to calculating the amount of dividend we're going to distribute, because it's all about just earning the time decay. But that is also an interesting factor with all of this, that if you do have a long run on Tesla going up, the ETF will appreciate along with that. If you have a long decline, well, we're going to feel some losses on the way down to, again, where we just feels like we're a long stock first and foremost, and then earning off the cover calls.
Oh, I think it's my turn. I was just gonna ask Jay, it all sounds amazing. So I was gonna ask, is there a fine print here? Because if a stock goes up or down, it doesn't matter. You win, maybe you give up some upside, which doesn't sound terrible, but you make up on income. A lot of volatility, a little bit of volatility, doesn't matter. You generate yield. It's like, so is there a shoe that can drop in the middle of the options magic?
Yeah, so Gavin, I'm waiting for you to now deliver me a magician's hat at some point.
You might get it. You might get it tonight, Jay. I can work.
We should go buy one of these. We should have him up on the bell with like the Fantasia. The
big purple with the stars on it,
the Mickey Mouse with the stars, and get a wand.
Yeah. Great. That's why you're not coming, Mike. Now I get it. You don't want to be seen with that.
Right, I'm more inspired to come now, man. I'm just
all right.
Let's see what the COVID test says in 10 minutes when I take it. That's what I'm worried about.
So to answer the question about what's the gotcha, I'll say it another way, right? What's the gotcha here? It is a covered call strategy. And what we saw in the first month of the ETF, right? I think we went from 20 to 13, right? Because Tesla went from 180 to 100, right? That's the risk, right? So when I talk to advisors and clients about the product, look, it's going to have some volatility to it, right? Like anything, you should accept that you carry Tesla type risk, a little less, but really you're carrying Tesla type risk when it comes, because there's some calls that are offsetting some of that risk, but that's the kind of risk that you're carrying. And so, is this something I'm putting our 85-year-old clients into at our practice? Not too much, not really. Actually, I would say it's not appropriate, right? So it still needs to be appropriate for what I would say a moderately aggressive and higher investor, because you will have those ups and downs. When it comes to the options themselves, is there any gotcha there? I mean, the gotcha that would exist with any kind of exchange product, right? Do the markets close before an expiration and you can't trade out? I mean, there's the standard stuff like that, right? An unexpected market closure is always the thing that gives me the biggest, agita out of anything that could happen to us. But that's it, right? Treat it like a covered call. It's a volatile stock is the underlying. By the way, we don't always have to do YieldMax on volatile stocks, right? I'm kind of priming the pump there for something else if we want to lead into it. But you don't always have to do this type of strategy. But like all things, you want to take less risk, you get less return.
Yeah, and I think, to say it really, really simply, what are you doing in a buy right strategy? You are trading some of your upside for income. Right. I mean, that is plain and simple. So there is always a trade-off. There is no free lunch. And that's obviously what everybody should understand.
Which in truth, this level of income doesn't feel like much of a trade-off, feels like a win, which is, it's just really amazing. But if I may slide in a second question, it's completely unrelated, but I'm dying of curiosity, is to Ray Scheimer. Like, where are you today, Ray? I mean, that background looks amazing and it's definitely not where you are usually on Thursday. So I'm just curious.
It turns it's nice, Cynthia. It turns out that we've got some of this in North Carolina, where I'm based. We've got some of this unseasonably warm weather, like 80 degrees. So I'm on my porch.
Oh, and it looks like it's a rocking chair.
It's not a
I grew up in North Carolina. I grew up in North Carolina. I know about porch sitting. Porch sitting's a thing in North Carolina.
I'm jealous. Officially, I'm jealous. So sorry, Jay. Go. I'll Weisskopf take over.
I'm surprised Ray doesn't have a question, but he'll come back with one, I'm sure. Here, listen, I'm sure I'm ahead of myself in asking this question. My question is, looking out, there's clearly an expertise that's required here, right? And Jay, you're the man. Sometimes these things are priced really, really, I wouldn't say cheap, but exciting. I don't want to use the word cheap because it's all relative, right? And sometimes they're not, right? A year or two from now, when we have 20 of these things out there, right? Active management by you to move around in a basket of these things could be like phenomenal, right? I mean, sorry, Mike, if I'm getting ahead of ourselves, but it's a fair vision, right? You got any dreams, Jay, of such a thing occurring?
I don't know where you're going, Dan. Actually, I think maybe Gavin, you want to take the idea about why we, filed for so many out of the gate, right? You want to?
Yeah, I mean, there's always, I don't know. Well, there's different ways to look at that, right? There's a land grab kind of element of it. We were excited and we thought it was unique, and we thought that there might be some copycatting. By the way, there has been quite a bit already. There's a Canadian firm that did a very similar suite of product since we've launched, and we wish them success. And we've seen some of the issuers of ETFs that we referenced in some of our filing come to market as well. So Crane Shares did that on KWeb. And then maybe actually more interesting to me, Jay, was that BlackRock did similar product on yielding instruments, right? And we filed for TLT, which at first glance, I was like, why would we do TLT? And it's like, well, no, actually, this is like really powerful, right? I think, Jay, right, it would almost double the yield of something like TLT in a strategy like this. So BlackRock came to market. So some of it is business sense and trying to kind of get territory, if you will. But it was also back to the point of having a mix or diversified number of assets, reference assets. One, because they will have different volatilities, and there's trade-off there. And the second, of course, is these are really good products to use as so if you had a slug of Tesla in your portfolio, right, you could take 5% of your 100% allocation and all of a sudden, generate a very different risk reward profile and a very different income profile. So of course that works for those individuals that have a lot of Tesla, but we filed and are very, very seriously contemplating launching Apple, obviously a very well followed stock with huge allocations across the community. So mix of business sense and a mix of utility, I would say.
Yeah, I obviously that's all consistent with what we had discussed before. And I would add to that, look, when you think of a use case, right, for this product, and Gavin just laid one out, hey, I'm already long, Tesla, why not carve out something that's going to give me a little yield? So allocate to the thing that I'm already comfortable with the risk with, but now all of a sudden I'm going to have, an overall yield. If I put 10% in, I'm going to get 6.5, theoretically in my dividend. But, we're in this environment now where, yield, there's the word, sorry, I said it again, yield is king. And because there's so many questions about which way this market's going to go when you have a 5% treasury. And, as investors and advisors, we're constantly answering questions from clients and trying to make that decision. Is it just time to be long the market? And, that's not the answer everybody's giving anymore. So looking for alternative ways to help kind of bridge that gap of what worked since, the last 10 years, and now it's not going to be what works going forward. This is a product that kind of helps do that. And so by having multiple tickers out there, having, 15, 20 of these in existence will help really the end investor diversify their exposure. It'll also help them with, creating, like I said, alternative income, a different way of earning, this type of a dividend and yield in the portfolio. There's the other use case here that we talked a little bit about the growth side of this. where if you have an aggressive investor that is looking for growth, capping the upside, and Cynthia, back to your point, capping the upside when you have this kind of a yield actually isn't really getting capped if you reinvest those dividends, right? So at that kind of a rate, what we're returning today in these aggressive tickers, you double your share count in 15, 16 months, right? So you're actually paying, when you're reinvesting back in, you're kind of paying to compound at a rate that's, I'm not sure there's much that matches that kind of a compounding rate on the street these
Not
days.
at all. I mean,
Yeah.
just thinking through that idea, like it breaks so much math. The idea that you're buying that many shares, like I think of all the the hodlers out there. Like, imagine if they could do that with this. I loved where you went, Gavin, with the fixed income one. So, like, I get called one of the original ETF nerds. The first ETF trade I ever did was 100 million into a $4 million ETF. The second ETF trade I ever did was I bought tips and sold calls against it. And that was throughout 08. And that's essentially what we're doing here, right? like that was the only place to hide for where I was in 08. In 08, I was at a place where we were long only 15 stocks that nobody else owned except us. So it was not a good year. I want to talk through the fixed income one though, because it's such an amazing concept, right? They're literally designed to create income, right? But you start putting bonds into a traditional index, and this always blows me away. Traditional index for bonds is let's buy the biggest debts, right? That's it's so ass backwards, right? At least with market cap weighting, you can say, hey, you're buying the most liquid names. No, with bond indexes, especially corporates, you're buying the ones that have issued the most debt. It's so counterintuitive. Now, number
and
two,
not just corporates, government too, right?
Yeah,
It's based on issuance.
Yeah. And then you're trying to get yield out of it, but that yield is not based off of any single time. Like, I think that's why the market went so crazy last year for these new bond ETFs that own, the closest one, the 2-year or the 10-year. They only own one issue. They don't run an index. What's happened to a lot of people is they thought they were buying bonds when they were buying bond indexes, and a bond index behaves a hell of a lot more like a stock than a bond. It has no maturity. Its income coupon changes constantly. So the idea of using options to change that return stream to make it behave more like a bond, right, is pretty cool. Outside of the 20-year treasury, where do you see other bond, call it volatility? Would you look at high yield or junk or senior loans? Where is it? I don't know if I'm asking a fair question or just telling us a little.
Yeah, no, that's okay, because we looked, right? We looked at HYG and J&K, and there's this weird dynamic when it comes to the option chains that when you have a higher dividend on the actual stock or ETF that you're looking at, you get this larger skew in the put values, right? Puts values goes up because the dividends are kind of quasi exposed in the option chain. Well, you don't get a dividend from options. The options reflect the potential drop in price from a dividend distribution. And so what happens is you get a little weirdness and you get a little out of whack, where in the environment today, right now, where calls have more value, premium than puts because of interest rates, you actually end up getting that netted out. And believe it or not, it was not as much of a lift from selling calls on an HYG and junk. Like, the market knows those dividends are coming and they're already high enough, and they are reflected in a reduced premium in the call side. So you'd have to get a little closer, which is why TLT is beautiful to put, when we filed for that one, because at the time the yield was, I think, 1 or 2%. Now it's higher, but there's so much vol in the longer duration bonds that then offsets this weirdness of a high dividend ETF. I think the duration on HYG and junk is maybe like 8 years, right? Whereas TLT's 20, right? So you end up just getting the duration volatility in there. So if there was, the ideal
TLT's 17, that's why it's broken. It's supposed to be
Yeah,
20.
All right, well, there you go. Sorry,
Yeah,
wow, that feels like a hot topic for you, Mike. I don't want to go too deep in that.
It is.
But
Yeah.
but my point is, if you could find, high yield with a 20, duration, right? That kind of a fund would be amazing, right? Just today, I don't know one that exists or has the liquidity to handle what we've got. But there is weirdness in there, and we looked, right? We really did look, because you can synthetically create, dividends by selling put spreads and things like that. And so it would be a little bit of a different approach here, but it could certainly fit into the YieldMax family down the road.
So before we go to Ray and Eric, years ago, David and I worked on a huge research project on the mispricing of options that are on leveraged and inverse ETFs, right? Because everybody's using Black-Scholes and they're using the volatility, but there's decay in those products because of the daily reset. And we did a whole thing to show that the options market didn't price them right. You needed to look at a third instrument, which was the vol, which determined the decay. And we built this whole calculator. Could you see a YieldMax on a leveraged product? Like,
Gavin wouldn't let me do it. I asked him.
I believe
Gavin didn't come to me then.
Jay is telling lies today. It was the opposite, and every time I don't know if it was actually a leverage product, but I definitely at some point, because of my background, I'm like, oh, VXX. Let's do VXX.
Oh, I was thinking that one too.
Right? And Jay was like, please don't call me again about this.
It's hard trading VIX options, buddy. In all fairness, I think our problem with those was like the VAR calculation, right? You can only have so much of a participation in the downside in ETF, right? I'm not the one to quote that rule, but what I'm learning now with these kind of products, you want to be careful that that you meet those guidelines. And that doesn't sound like the most interesting thing to talk about, Gavin, but I think we learned a lot about VAR calculations.
We won't go too deep, but there are some regulatory constraints that would have to be considered, blah, 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 blah. No, but in all seriousness, right, I think there are other interesting reference assets that we will continue to consider, but this was a great place to start.
Yeah, I mean, I love it. Like, what if we went synthetically short the long and the short leverage one, and then did the options and come off of them? We'd solve the VAR and we'd buy the decay.
Listen,
go ahead, Ray.
I love shorting the leverages, right? Pair up short leverage against short leverage. It feels like everybody. The problem with that, Mike. Sorry, and I know we're going down a rabbit hole, but you started right. Like, was the availability of shorting notes, right?
Yeah,
and
but
then
like
the options
the triple
market had
financials,
to
the triple energy.
It's
out there.
He's right, though. It's the borrow cost of those that just gets so insanely high that it erodes all of it. But there's a trade there. I've been looking at that fucking thing for years. There's got to be something there.
There is.
There's something there. All right, Ray, take us out of the rabbit hole.
Well, I'm afraid I might be digging it deeper. So,
I love it.
So as options math is kind of spinning my head with this thing. Any thoughts as far as pairing this with a buffered ETF? You'd lower the yield and you'd lower the volatility, but you'd still, or are we just canceling each other out? I'm just trying to, as far as, because those are all options.
But before Jay and Gavin get in here, that was the original one that was on my whiteboard that I showed Gavin before we got to this one, was the buffer, single stock buffer. I don't think the appetite's going to be there from the market, but I'll let Jay and Gavin hit it.
Well, either a single stock buffer, or just like if you're doing Tesla, if you did a QQQ buffer or something like that, just to try to take the market bait out of the thing.
You guys, what do you think?
Yeah. So I wasn't sure, Ray, at first we were going to go with that. Actually, one of the initial, clients that have used the current ETFs, whether it's the OA RK or the Tesla income strategy, that individual, that advisor actually pairs up the YieldMax ETFs with his buffered notes. He does some structured notes, and he also uses buffers, and actually he uses it as a way to get some yield in his portfolio while he's waiting for those buffers to run their 1-year course. And so you're not far off on the idea of linking these two pieces together as a way of kind of creating a portfolio that is, now you're getting yield and you've got the S&P exposure and you've got some hedging, right? Like it all matches together. Like all options-based ETFs, it could be more exciting for me as the options guy, but in all honesty, like there's a lot of folks that's one of the use cases, Ray, that we've already seen out of the gate on these.
Thanks.
Eric and then Lily.
It's maybe getting a little too much in the weeds, but looking at the kinked beta to Tesla for the Tesla, the upside beta is about 0.55, which I get. The downside beta is about 0.85. Is that purely an artifact of the path dependence, or why is that?
Well, yeah, I mean, that's the exposure of the covered call, right? I mean, the covered call build, right? Right. So the long stock is got all the risk on the downside. And look, like, again, it's been an extreme example, right, of the time period that the Tesla income strategy has been around.
But you're ready to a delta of like 0.85 or something, right?
Yeah, I mean, that's right. So if we're 100 delta on our synthetic, right, and then I'm selling 20 deltas, generally I'm in the 80 range. And if the market drops, my delta approaches 100, unfortunately, right? And if the market goes up, my delta approaches 50, right? So that's generally how that goes. Yep.
I think though, Eric, if you were reinvesting the dividend and looking at a TRA with dividend reinvestment, it's going to be way more symmetric. Right? Or maybe I'm not.
Yeah, it's looking price only.
Right.
The dividend's going to be really path dependent because when the stock gets called away and all that stuff.
Yeah,
it's just looking at dailies.
Yeah, I get it. Lily.
Oh yes, I have a question. On your Tesla product, that means that you're perpetually longing Tesla, right? In order for your strategy to work. So that means that if you were wrong on your strike price, you would cover and keep the stock and then roll it to like farther out instead of letting them take your stock away.
Yeah. So point of clarification, we actually don't hold the stock, right? When we're talking about the synthetic, the options make it feel like we hold the stock, but we actually are not holding any stock. And you're right, we don't want to have it if somebody assigned us on our short calls, we would end up being short Tesla, right? So we would just be neutral against our synthetic in that scenario. That's not something that we want to let happen. And the way to avoid that is to watch the extrinsic left in the option. And so again, it goes back to the active management piece. So let's take an example, right? If so not to get too deep in this, if Tesla was at 200 and we sold the 210s and Tesla went to 220, the benefit of the volatility is those 210s are going to hold plenty of extrinsic value up until the very end. Now, if somebody was to exercise us, assign us, we would actually get a little free juice on that, right? We'd earn that extrinsic overnight, but we would be neutral Tesla. So we're not taking risk here. We're just, we would lose our, intraday exposure on Tesla. But we watch for that extrinsic to drop, and then we're going to roll those calls, right? We'll either cover them, we'll roll them out, right? Because we don't want to get assigned Tesla at all. It's also why I mentioned early on why with the flexes, we go European style, so we don't get assigned on our short put. So assignment is something we want to avoid. If it happens, we're not adding risk. Actually, what we're doing is we're getting much more neutral in that scenario because we're synthetically long. But we still don't want it to happen, so we're actively managing those short strikes.
Okay. So that means that the short sellers of Tesla are your best friends, right? Like Bill Miller?
Like that day, right? But not overall. Like on expiration day, like, yeah, sure. We like for the options to expire worthless. That's, the cleanest way of managing the portfolio. Of course, it's only going to happen, 50% of the time. By the way, there's a lot of times, I think I mentioned, those options expire, get to like zero extrinsic quickly. Right on the, ARK had a much harder week than Tesla did this week. So guess what? Those ARK calls that we sold last week expired, down to zero, much, much faster. And you get to sell those calls again. You cover buy them and you sell them again. Sometimes we could sell multiple times in a single week. Again, it's all about the extrinsic going to zero. It's all about earning that time decay. And that's the main strategy. When we earn it early, we're happy to do it again.
Okay, so the worst thing would be for Tesla to just like stay the same price for a long time, right? Then
Oh,
they'll
that'd be ideal. No, that's ideal. That's
That'd be
perfect. We
ideal.
love that. Yeah, that would be great. Tesla, a flat Tesla. I mean, we'd eventually lose the volatility, but flat Tesla is great because we would sell those calls every week and let them just tick down to zero without it going through our strike price. Again, I think the worst case scenario is kind of what we saw earlier on in the release. Tesla dropped by 50%, 40%, in a 3-week period. That's just bad for the NAV on the fund, but we still earned actually our highest dividend so far, to date on that month, just because of relative pricing. But yeah, I still think you still have the downside risk on Tesla is like, to me, the biggest gotcha.
You want normalized returns. You just want to avoid the spikes in either direction. You want,
Yep.
if 90% of a movement up or down happens in like a 1-week period over a year, that's really bad. But if it's more distributed, then it's not as bad.
Yeah, my dream on these are plus or minus 10% a week. Like that's great for us.
Yeah.
You have to pick
Yeah,
the
I
ideal scenario. There it is. Pick that.
I can't wait till they list options on these funds.
There
And then
are,
you-
by the way, Mike.
There are already options on these funds?
Yeah, there's ARC on.
Well, what if
Tesla.
Sailor buys the MicroStrategy one on his balance sheet? Like,
No,
Let's not go there.
let's not even go there yet. But I also saw today on one of the other ETF newsletters listed the top shorted ETFs, and the Tesla one, the Tesla yield one, Tesla was on there. This seems like the dumbest thing for somebody to short because every month they've got to cover this insane dividend. Like,
Right. Right.
yeah.
But doesn't that tell you that, to your point earlier, that people don't really understand, like to the point of investing in a bond, they're actually getting that bond index, and
Yeah.
the amount of education that's needed around these kinds of products is huge.
Yeah, it could be a market making issue too, quite honestly, because it doesn't make any sense that somebody.
I mean, it says that
Go
37% of this float is short. Like that just
Yeah, but it could be
somebody's gonna
market
get their
maker,
face
right,
ripped off.
NAP or something. Yeah,
Yeah.
Well, they'll
Yeah.
learn. Pain is a good teacher.
Yeah. Pain is a
the
good
carry's
teacher.
too expensive. Yeah,
well, that's
Um,
honestly, if you want to get geeky, that's someone's a black swan hedge, right? Like, in theory, I don't know. Like,
No,
could be.
because the shorting things that have high dividends is like an absolute nightmare because you don't get the dividend, but you have to pay it.
you've got to pay it. Yeah,
Yeah.
it's stupid.
That's why
And-
like ETFs that have continuous dividends, they don't have shadow shares. Right. So like, we have some high octane ETFs that we're involved with. They'll go on forever and ever without creating, because until they pay a dividend, all the market makers like to have, half a creation unit or two sitting around and hedge everything. As soon as you pay that dividend, all of a sudden or declare the dividend, all these creates come in because they don't want to be short to have to pay that dividend. We have the only fund in the world that pays a weekly dividend. It never has phantom shares, right? Because as soon as they're ready to create, they create, because they don't want to get caught paying, that 5 cents or whatever it is each week. Listen, we're at the top of the hour. We really want to thank Jay and Gavin for coming on, talking through all this. Look for them on the opening bell tomorrow morning. I'm 50-50. We'll find out soon if I'm coming. We don't actually have a guest lined up for next week. So if you got somebody you think we should have on, reach out to Cynthia or Guyette or Weisskopf or David and suggest somebody. Don't reach out to me.
Or by the way, or if you think that there's a stock that should have a yield associated with like these, let us know.
Or
we
if you
love
want to
ideas.
launch that ETF with us, come launch an ETF with us, right? That's what we do. So that's it for today, folks. Thank you, everyone, and we'll see you soon.
Thanks, everybody. Thanks, Jay.
Thanks, everybody.
Gavin. Bye.